we were hoping maybe the turn of the calendar like January would do this. Stock futures are down about 100 points as well. Do you see continued weakness for the markets?
We do. We think that you've got a real opportunity for a sloppy summer that could even kind of last a little bit into the fall. And Brian, key issue here for us was what happened last Friday. You know, as you know, and we've been talking about for a couple of years.
You were more positive. You were, I don't say overly bullish, but you had pockets of strength.
No, and we still are. I mean, look, we still are, as you take a kind of 6, 9, or 12-month view, we think that markets will be higher than where they are right now. But we've gotten the China trade war. We understand what it's about. We understand the rules of the game. We don't like maybe the most recent developments, but we understand that. But Mexico came out of left field, and it introduces a level of uncertainty that says, look, we could use tariffs on any issue, even if it's not primarily an economic issue. And that's a lot for the markets to digest.
It's getting no attention today, but actually over the weekend, President Trump ended India's developing nation status. 2,000 products are now going to be subject to duty, or basically a tax. So it appears that the trade war is spreading, not contracting.
Well, apparently we were on the verge of tariffing aluminum and steel coming out of Australia, which was another thing that was just kind of talked back. So again, the issue with the China trade war is if you have an industrial revolution based on these new technologies, AI, robotics, Internet of Things, you need to protect your intellectual property. That's a worthwhile goal. We get that. But you can't fight that and Mexico and start tiffs with with India. What's going to happen with those auto tariffs in Europe? This is going to take a little while for the markets.
But here's the problem, Steve. At Federated, your clients, they've got to put their money somewhere. They've got money. It's not like they're going to take it and bury it in the backyard. What are you advising clients to do with their money right now? I'm sure they're nervous. I'm sure they're calling you and hammering out the emails.
We get some calls. No, look, I think the first thing to do is a good multi-asset strategy, something that's flexible, whether it's a global ALM fund or an income-based fund.
What does that mean?
So it's a fund that can go anywhere. So it's a fund that has the opportunity, or an investment strategy that can go to U.S. equities or international. It can go to fixed income. It can go to long-short strategies. It just has a lot of flexibility built in. We think that in volatile times, those are well.
Is that all equity? Is that a little bond, a little cash, a little?
It's all of that, and it can switch. So, for example, the global allocation fund that I'm a part of can go all the way, up to 80-85% equities. It can go all the way down into the 30 or 40%.
Where are you now?
So right now as of the end of last month, we were about 5% overweight equities. Obviously, we're going to take into account what's going on now and adjust that. Can't disclose that in real time, but.
Well, listen, the markets are down, which means people are selling. I mean, stocks go down when there's more selling pressure than buying pressure.
And then you also have opportunities within the equity market. We think in dividend names, for example. These are those big diversified companies that have solid cash flows. They're paying a dividend. The 10-year yield's gone from 3.25% to 2.1%. That looks attractive here.
And I was going to say, at some point, Bob Pisani down at the NYSE, he's going to talk about how there's been an investment. I'm not putting words in Bob's mouth, but it's going to be a shift in sentiment. Say, if we're at 2% on the 10-year, a 2.5% to 3% dividend yield on a stock looks pretty doggone good.
I think it looks really good. And I think, when you look out 6, 9, 12 months at the health of these companies, their balance sheets are fine. They're still generating a lot of cash. This makes sense. And when you have volatility, these names tend to be a lot less volatile, which I think is comforting in this kind of environment.
Will 5, 10, 15% added tariffs on Chinese imported goods, or Mexican goods, will that destroy the U.S. economy? It
doesn't destroy the U.S. economy, but think about it this way. When you add all the Mexican goods that could be tariffed at 25%, plus all the Chinese goods, you're talking about 35% of U.S. imports. That's going to have an impact on earnings. It's certainly going to have an impact on sentiment. And if you're a company, where do you invest? Think about GoPro. GoPro on May 13th announced that they were leaving China to move production to Mexico to avoid the trade issues. That, other CEOs are going to see that and maybe put the brakes on for a while until we get some clarity. So, look, I understand in large part what the administration is trying to do with China. Mexico, I understand that there's some goals there as well. Maybe not so much all at once for the market.
But if we had to hide out somewhere, you think the big cap, strong, high dividend paying names look at the most attractive, relatively?
I think you want flexibility in your investment management, and if you're going to be in U.S. equities, which I think is still the best place to be, you want the big safe names that are paying a good yield.